Alright, so you guys are looking at working capital management. Okay, it's FIN3702. It's the last module that uses the same textbook as FIN3701 and FIN2601. Alright, so the textbook, most of you probably have either the first edition or the second, depending on when you chose to write FIN2601. I did recommend the second because they're using that in the third year, and that's the textbook that's prescribed for this particular module. Alright, so the first bit is obviously just background. Okay, we spoke a bit about why Boston has had to close the UNISA side of the business, and I've chosen to create my own business, okay, in terms of running support classes. Okay, so those are some of the values that I'd like to instill in this business, and obviously CS Education is offering the private support classes and tutor services. Alright, you guys have signed up for the weekly classes. Alright, so you've obviously got access to live interactive classes. Okay, so those are obviously the best in terms of being able to cover all the content in the module. The support material, I've given that to you today. Okay, Indira, I'll give you the rest of the pack as soon as you've sent me proof of payment, then I'll make sure you get it next week. I will go through worked examples, right, and questions, okay, to make sure you guys are okay with understanding in terms of the content. And then on a minimum, okay, I'm going to cover 2 past papers with you. Right, I do have more, so you will get more than 2 past papers, but I've obviously just committed to minimum of 2. Right, and even after we've finished our 10 weeks of lectures, right, or let's say during the semester, you're stuck with a concept or you're worried about something, I don't mind arranging, let's say, a telephonic session, Skype or WhatsApp, or if you want to just send me an email with a question, have a look at this, I'm struggling, can you help me? And I'll obviously respond and give you some feedback regarding that problem. Okay, those are all my contact details, and that's pretty much the scope, okay, in terms of Creativo Solutions. Creativo actually means creative in Spanish. Okay, that's where I got the name from. Okay. Alright, so to start off, you guys would have been given a study guide from UNISA. This FIN study guide is actually pretty good. It summarizes all the need-to-knows, and they do give you examples, which is great. The examples they give you in the study guide are very similar to the type of questions you'll see in the test and or the assignment and the past papers. Alright, try work as consistently as possible. Okay, try don't leave everything to the last minute. And we spoke about the textbook. Second edition is the newest. Okay, and is what's prescribed in terms of UNISA from a third year point of view. You guys all have a financial calculator, so that's great. Right, you're going to be using that a lot in this module. And then we'll talk about the assignments closer to the time. I'll remind you to have a look at the assignments before we do it in class. Alright, you've seen this before in some of my other modules. Try pre-read if you can. That's textbook related mainly. The textbook's definitely your focus. Right, so always use your textbook as the source of information and then use everything else to supplement it. Right, this is quite practical. You can apply a lot of these concepts in real life. So we'll look at things like managing debt, okay, in terms of short-term credit, not long-term credit. This is all short-term working capital. Okay, that's the focus. Alright, so to start off, a few things we need to know from FIN3701. Okay, there's always a little bit of overlap, okay, from subject to subject, purely because the foundations are universal, they're key. Right, so the main bits and pieces that you'll need from FIN is the time value of money, okay, which you've covered a lot in all your modules. Okay, that's universal. And then we'll also look at things like risk again. Okay, but more the short term. So what short-term risk do we have? How do we manage that? Okay, and also things relating to budgeting. So NPV calculations can still come up in this module, right? And also some of the ratios. Okay, so ratios you've covered all the way back in FIN 2601. Right, even having covered that so long ago, some of it still comes up in this particular module. So you'll see things like current ratio, perhaps asset test, average collection period, average settlement period. Those are types of things that can come up in this particular module. Okay, so to start off, topic 1, it's all introduction. What is cash flow? Okay, good. Right, so we're looking here at inflows versus outflows. Right, do businesses go bankrupt because they don't make a profit? No. Okay, businesses go bankrupt because they don't manage their inflows and their outflows far exceed the inflows. Okay, that's the main reason why businesses go bankrupt. Remember, accounting is focusing on profit. Profit isn't a measure of cash flow, correct? Okay, and that's why we have something called a cash flow statement. Right, the cash flow statement you would have covered in 1601, and you broke up cash flow into 3 categories. Okay, we'll see that again later on when we look at operating, financing, investing. Okay, so I'm hoping that's still something that's at the back of your mind because it is considered in this particular module. Right, remember, from a financial management point of view, what are we doing? We're decision makers. Okay, so we're using the information from the accountants, bookkeepers, etc. to make a decision. Right, how do we manage our cash flow? Okay, and this whole module is a lot shorter, okay, in terms of content. There aren't as many chapters, right? It's a lot shorter, that's why we don't have as much, we don't need as much weeks, okay, to complete it. Okay, so we've just got the 10 to get through what we need to. Okay, so what is financial planning then? You guys have a good idea of cash flow? What's the planning part of things? Good. Okay, so here we're looking at the resources that are limited that need to be allocated. Right, so a budget is something you are expected to create. Okay, so 3 months, 4 months, 6 months, depending on the situation. Okay, you need to do the planning. Right, planning looks at the future. Right, so in the future, what am I going to expect to receive? What am I going to expect to pay? Right, and that obviously builds a budget, and the budget can be used for forecasting, it can be used for decision making, it can be used for a lot of different applications. Alright, so your scope. Each and every one of those blocks represent a different topic, okay, or chapter, right, in this particular module. Right, so this module focuses on cash flows in terms of firm's cash flow, so you get free cash flow to the firm, FCF. You also get more generic cash flow in terms of OCF, okay, operating cash flow. Right, you've seen OCF before. Free cash flow might be new depending on whether you've covered other modules or not. Okay, it has come up in other modules. It might be new for most of you. Okay. Financial planning, we'll discuss the process. We'll look at managing net working capital, right, and other. Okay, the main focus with this particular chapter is this. Okay, the cash. All right, because we just said companies go bankrupt because they don't have sufficient cash on hand. All right, so it's not because I'm making a loss. It's because I have an outflow that exceeds my inflow. Okay, if outflows exceed inflow, I am going to struggle to pay obligations, and that's going to create a problem in terms of collections as well, and that's going to harm the business. Okay, so you should be more concerned about cash flow than you should about, is the business making a profit, yes or no? Okay, yes, profit's important, but it's not the main focus. Alright, so to start off, Chapter 1, or Study Unit 1, analyzing the firm's cash flow. Alright, so this is looking at money coming in, money going out. That's the focus. Right, most important chapter, or let's say background information that I can give you here to help you with this particular course is the FAC. Right, that's probably the best module, okay, in terms of prior knowledge and information that can help you in this module. Right, having said that, it's because of this, the cash flow statement. Okay, so if you know how to adjust non-cash items, if you know how to process cash versus credit and those types of considerations, right, this particular chapter, okay, should be relatively easy to cover, and you shouldn't have too much of a problem with this in tests and exams. Okay, so remember your format in terms of tax. Okay, so we know tax is a payment, so tax will obviously affect decision making, right? And we know certain expenses are non-cash. Okay, so something like depreciation, is that a benefit to the business? It would be because of the tax savings. All right, so as much as we don't want assets to lose value, they are going to lose value. And if assets lose value, how can I benefit from that particular, let's say, inevitability, okay, in terms of something that is going to happen whether we like it or not? And the answer would be tax savings. Okay. All right, so in the textbook, Chapter 3 is your focus, right? And they discussed quite a lot of let's say, background information, okay, in terms of managing cash flow, okay, and what day-to-day activities the financial manager needs to do. Okay, so what are financial managers responsible for? It's the day-to-day running of the business, right? In terms of finances, right? So, do we have sufficient cash to pay all our suppliers? Right? If we don't pay our suppliers, we're not going to have stock to run the business, right? Financial managers need to plan. Okay, financial managers obviously need to make decisions. Okay, you're in a managerial type of position. Okay, so the decision lies with you in terms of what we should and shouldn't do. Budgeting, key, and we know all departments have to budget. It doesn't matter what department you're in. Okay, all the budgets get consolidated, let's say in the finance department, okay, but you're still going to have to consult with all the separate business units. Okay, so IT, sales, etc. Okay. Legal, procurement, there's so many different departments in a business. Obviously, bigger businesses have more departments. They segregate the duties quite a lot. Right, but the ultimate goal for the firm, which you should know, wealth maximization. Okay, that's the key. Alright, so the focus is always on wealth or value. Right, and even when looking at managing short-term cash, we need to know how do we maximize value by managing short-term capital, right? Because short-term capital will have a bearing, would affect or have bearing on long-term decisions. Okay, in terms of how we're going to pay for certain income and expenses. Okay, so some terms that you need to be familiar with, right? This is a little bit, as I said, of assumed knowledge from prior modules. First bit is depreciation. Okay, let's define depreciation. Well, it's a systematic charge of apportioning, okay, the cost of fixed assets. Right, and how else could we define it? We could just use a simple word, use. That's all it is. Okay, so when thinking about depreciation, we know cars depreciate. We know machinery depreciates. Equipment depreciates. Why do those assets depreciate? It's because of use. Right, the more I use the vehicle, the more I use the equipment, the less it's worth. And that's why SARS, okay, will allow you to claim a wear and tear allowance on certain assets. Okay, and the reason for that is to do what? Why do we have wear and tear as part of the allowances, okay, from a tax point of view? Correct. Okay, it's to incentivize business to purchase assets. All right, because what incentive do business have to purchase assets other than to increase efficiency? Okay, so you might want to buy, let's say, a vehicle that's more fuel efficient for delivery. Okay, so if you're delivering goods across the country, obviously fuel is going to be a very big cost on your income statement. All right, so for your business, buying a vehicle, the main decision would be, well, I'm going to save on fuel costs. Okay. Another reason would be to incentivize growth. Right, so if the government didn't have a wear and tear allowance on certain assets, businesses wouldn't have any incentive to buy assets. And that's why businesses normally upgrade systems. They normally upgrade computer systems, servers, let's say equipment, machinery, and so on. And the reason why they do that is because they get to claim an allowance, only because they're operating. You and I don't get any benefit from buying new assets. If we buy a new car, right, if you're not running a business, you're not going to be able to claim any depreciation. If you are, then you would. Right, so depreciation only makes sense to what type of entity? A business that can claim for wear and tear allowance. Right, so do all assets have the same depreciation? No. All right, SARS issues a practice note, okay, and those notes determine how long you can depreciate certain assets. Okay, and you'd make a note of that in your asset register, because every asset that needs to be purchased needs to be monitored, because those are important. Why? What do assets do to the business? They generate income. Okay, so because assets generate income, I want as many assets as possible. Okay, certain assets are depreciated over longer or shorter time, depending on the type. Okay, but SARS gives you the guidelines for that. Okay, so let's see if you guys can still calculate depreciation. Here's your first working. What cost would we include in the total cost, guys? Correct, everything. Right, so you can't use an asset if it isn't installed. You can't use an asset if it isn't set up. Okay, so the depreciable value would be based on the total cost, which is everything. Installation, setup, all types of costs. Right, because you wouldn't have that particular asset if you didn't install it, okay, or use it. You wouldn't have the use of that asset if you didn't install it. Right, so simple question at the bottom. What is the depreciable value of the machine? Correct. 520. Right, so those are some of the considerations in terms of what we should include. What do we exclude though? A little bit of revision from accounts. Scrap value, residual value. Okay, so you wouldn't depreciate the residual value or scrapping value. Okay, so in accounts you would have covered more advanced calculations for depreciation. Okay, I haven't seen that advanced calculations in this module, right? They haven't really considered the residual or scrapping value, but it is something just to think about, not to say they can't test it. Okay, could come up, but hasn't come up yet. Right, as far as I know, they have made some changes. So last semester, your exams were probably a little bit different to past papers that you've been doing ahead of time, right? There's been a few changes. Right, so it might be let's say maybe new academics managing those courses, and they're trying to refresh and revitalize that particular module, and that's why it changes a bit. Okay, it's good. Change is good. All right, yeah, well, it's a matter of perspective, but yeah. All right, so how long can we depreciate an asset for? Correct. Okay, but does that mean you can't use your own method? You can. All right, so that's why you have something. When I say deferred tax, does that mean anything to anyone? Okay, so deferred tax would be a consideration when you have your method, okay, and SARS's method. All right, because SARS, let's say on a laptop, you can depreciate it over 3 years. Okay, but then in your particular business, you're only going to use the laptop for 2 years. All right, that creates a difference in terms of tax. Because if you've got 2 years worth of depreciation sitting in your income statement, is SARS going to view 2 years or 3 years? They're going to view 3 years. They're not going to allow you to write off an asset over 2 years because now you've accelerated the depreciation, which means you've got a bigger tax savings in 2 years rather than a smaller tax saving over 3 years.
So, but then what, are you forced into future taxing?
No, you're not forced. Okay, no, you're not forced to use the 3 years, right? You can use whatever you like, but you are forced to provide for it, and that's the future. When you say future tax, all right, it's the deferred tax, yeah. Okay, so you do have to provide for it. Yeah. Okay. That's probably what you'll cover in the FAC module, if you haven't covered it yet. It'll probably be in the last module you're doing.
Yeah.
Okay. All right, every asset is different, and the time period for assets will differ. Okay, we just spoke about that. Where does the information come from? SARS. That's the main, let's say, control in terms of guidance relating to assets. Okay, so ideally, to save yourself a lot of accounting hassle, you would rather just depreciate the asset in line with SARS, right? Because then you're not going to have to worry about deferred tax. Okay. All right, 2 types of methods. You guys should be familiar with these. Straight line, diminishing balance. Okay. What do I use as the base of the calculation? That's probably more important than what is the actual depreciation. Okay, obviously, straight line doesn't change. It's equal. So, what do I use as the base? No. Well, cost. Yeah, well, cost in terms of depreciable value if you have other expenses that were added to the cost of that asset, yes. Okay, so agreed. So you can use maybe cost, or maybe a better word, depreciable value, that's fine. Okay, but it's basically the cost. You can't change that. If I buy the asset and I'm installing it, that's the cost that I'm going to use to depreciate it.
Do they ever ask improvements?
No. No, it's quite basic, yeah.
Is that not down the line?
No, you're not going to have to worry about capitalizing amount to an asset or anything like that, yeah. It's pretty straightforward. It's either take it out or add it back, or depending on the situation, yeah. Okay. Alright, and then diminishing balance, what do I use here? There's the answer. Carrying value. How do I calculate that though? Is it depreciation? Accumulated. Yeah, it's all of it, hey? Okay, accumulated depreciation. Right, so if you've got a 5-year-old asset, you would need to minus 5 years worth of depreciation. Okay, you don't only use the current year. Okay, you would have to use the accumulated. So what you bought the asset for minus all the use of the asset gives you what the current carrying value is, or book value, depending on which textbook you're reading. Book value, carrying value is pretty much the same. Alright guys, so simple calculation here. 100,000 Rand asset depreciated over 5 years straight line. 5 years can also be given as how much percent per year? 20%. Right, because 20 times 5 would give you 100%. 100 would represent the full worth of that particular asset. Okay, so 5 years, 20% straight line. How much depreciation a year?
20,000.
20,000. Simple as that. Good. Okay, is that going to change? No, you'll have 20, 20, 20 every year, right? For the next 5. Right, what about this one? 8 years. That will be what? 12.5%. Okay, so how do I get that? I'll just take 100 and I'll divide that by 8, and that's how I get the 12.5%. Okay, you don't have to convert to percent. You can literally take 400,000, you can divide it by 8, and you'll get 50,000. Okay, so 50,000 per annum would be the depreciation for that particular asset. Okay, not to say we can't have less than that. When will we have less than 50,000? Correct. Okay, if you're pro-ratering, okay, pro-rata for less than a year would have depreciation less than 50,000. Okay, so if you buy the asset during the year, you're not going to have the full 50. Right, how about this one, guys? An asset worth 300 must be depreciated for 20%.
60.
Exactly, okay. And these are the type of questions you'll see. Right, well, obviously part of a longer question, but depreciation will be as simple as this. Okay, if they give you straight line, or well, we haven't looked at diminishing balance yet. Okay, but 60,000 would be your depreciation. Okay, 300 times 20. All right, let's have a look at diminishing balance. Right, this does change the situation slightly. Right, because now I need to look at how many years. Well, 25% per annum would be 4 years. Alright, so this asset would be used for 4 years, but because it's diminishing balance, you're providing for its carrying value rather than its costs. Okay, so you'll see the depreciation will be less for each of those years. Alright, so how many columns do I need? I need cost, I need depreciation, okay, I need accumulated depreciation, and I'll need carrying value. Right, those are the 4 columns you'll need to do any diminishing balance calculation. Okay, so I'm going to do this separately, just so it's a bit neater. Okay, alright, so cost, depreciation, accumulated depreciation, and carrying value. Right, those are the only 4 columns you're ever going to need, okay, when doing a diminishing balance type calculation. Right, and try to keep it simple. You can probably add more columns if you wanted to, but it's not really necessary. Okay, I'm going to look at how many years? 4 years. So let's put a year column. Right, 1, 2, 3, and 4. Right, those are 4 years. Right, is the cost going to change? No. So if I look at my question, I'm not going to change the cost of that particular asset. Right, so this asset costs 100,000. Okay, I can copy paste that for all 4 of those periods. Okay, depreciation is key. Okay, I need to know how much depreciation will I have, okay, for the first year. Right, so how much depreciation will I have for the first year? Okay, this times 25%. Okay. Right, accumulated depreciation for year 1 would then be 25,000. Alright, so the carrying value for year 1 would be 75. Good. Okay, the 100 minus the 25. Alright, so the first line will always be easy to do because it's the same as costs. Okay, straight line. Right, it changes now because what am I going to use to work out the next line for depreciation? I don't use cost, I use this, the carrying value. Right, because the asset has depreciated. Okay, so now you're using an asset that's worth 75. You're not using an asset that's worth 100 because that has changed. Alright, so if I take the 75 and I multiply that by 0.25, I get 18,750. Okay, that's the depreciation for year 2. Right, remember accumulated is the sum or the total of all the depreciation for that asset. Okay, so am I in year 2? Yes, so I need year 1's depreciation plus year 2's depreciation. So if I take the 25 and I add the 18,750, I'm going to get the 43,750. Okay, that's the current year's accumulated depreciation, i.e. that's the use of the asset over all the years that you've been using it for. Right, and then you would do the same thing here. The one minus the other gives me that figure. Right, then the same thing applies. Next line, I use the carrying value from the prior year. Right, so now the vehicle's even less, okay, in terms of value. Right, so now I use that amount, okay, times it by 25, I'm going to get that answer. Okay, if I add up the depreciation, last year plus this year, gives me that figure. Okay, and then you'll continue to do that until you reach the end. Okay, so if you've completed the table, you would have ended up with 31640.60. Okay, is that alright, guys? Are we all okay with the diminishing balance method? That's probably the more tricky of the two. It's not that bad if you just think about it logically. Okay, every time I use the asset, it gets less. No, with diminishing balance, you'll never ever have 0. It's a repetitive process, so it'll just get smaller and smaller and smaller until we tend towards 0. Okay, so it'll be a limit towards a certain number, a limit tending towards 0. Okay, in terms of the math, the calculus. Okay, but if I just have a look, see, copy paste, get smaller and smaller and smaller, it never ever gets to 0. Alright, it tends towards 0, but it'll always not become 0 because it's a repetitive type of process. Okay, happy with that one, guys? Great. Right. Yeah, not quite. Okay, remember things overlap, eh? So obviously you're doing different courses over your degree, and obviously each course gives you a little bit of more information or a different focus or exposing you to some different concepts. Right, and then obviously you'll use that wherever, okay, depending on your application. All right, so no, you don't. Okay, so you don't have to draw up any of these statements, okay, because they're not going to test something you've already done. Okay, you've already created these statements in 1601. Okay, now it's more the interpretation and understanding. Right, so do we understand what each of these statements are showing? Okay, in terms of content, in terms of information. Right, can we use these statements for decision making? That's the focus. All right, so why is a cash flow statement so valuable for users? Right, remember you've got lots and lots of different users of financial statements. So who would be using the cash flow statement? Why would investors care about cash flow? All right, possibly. So you're talking about a payout, okay, versus a retention. Okay, that also is a consideration later in terms of dividends. So yeah, you could definitely consider that as a consideration. Okay, if I'm looking at operating, okay, what does that involve? Sales, right, day-to-day running of the business. Right, so what did we say we need in order to produce income? Assets. Okay, assets generate income. Right, so if I'm looking at assets, those assets are hopefully being used productively, okay? And operating will tell me how productive those assets are in terms of operations. Okay, so there's no point, let's say those assets are very productive, right? And you're generating, let's say, 100 million in revenue, okay, for the business. Okay, but in terms of operations, okay, your day-to-day running of the business is so costly, right? And you're sitting with day-to-day running of the business of 98 million. Okay, is that good? From a cash flow point of view, not. Because 100 million in terms of cash flow inflow versus 98 going out is not going to help much in terms of 2 million. Okay, versus let's say a smaller business, let's say half the size. Let's say a business worth 50 mil, okay? Right? And 50 mil in terms of cash, they've got 40 going towards expenses. Which business is operating more effectively? The smaller business. Right, so it doesn't really mean size. Okay, the bigger the business makes no difference. How is the business being managed? Okay, so in other words, good management, good operational management in a business could surpass in terms of size. Okay, so a small competitive business could compete with a larger organization if they're more effective in terms of doing more with what they've got. Okay, because assets look at that. And that's why operations, okay, are focused separately. Because think about money. What can you do with your money? You can use it for day to day, which is operating. You can invest it for tomorrow, or you can use it to finance today. Okay, so your debt and equity, okay, or investing large purchases of assets. Right, it all depends. Okay, is that alright, guys? Does it make sense? Okay. Alright, so investing is focusing on that, the asset side of things. Alright, so when looking at a decision, okay, if a company has negative, let's say operating, investing, financing, right, all three make up cash flow, right? And let's say the cash flow comes out to minus 100. Okay, then you look at the business and you see operations, okay, was 50. All right, investing was minus 250. Okay, and financing is, let's see, 50 will be minus 100. Okay, so 50 plus 50. Plus 50 minus 250 is minus 200. Plus 100 gives you minus 100. Right, if you look at that business, good or bad? Why good? Correct. They're investing capital, all right, into assets. Okay, so if a business had cash flow that looked like that, that's fine. Have a look. Same business, minus 100. Okay, operating, investing, financing. Okay, so now the situation's a bit different. Okay, operating minus 250, investing plus 50, and financing plus 100. All right, the exact same figures. The only thing different is what? This figure. Where are you spending most of your money? on operations. So are operations effective? No. Okay, your cash flow for operations are less, okay, than investing and financing, and that's causing the net cash flow being negative. Right, so where is this company bleeding funds? It's from operations. So something's wrong operationally in terms of the business. Okay, to consider in terms of decision making. Right, same business. I mean, if you just look at the last line, minus 100, minus 100, you'd say, well, those businesses are both bad. Okay, it's not the case. This business is better than the other because they're investing. Okay, so future growth. Right, so short-term, let's say, what's the right way of putting it? Short-term discomfort, okay, for long-term gain. Okay, so currently I'm sitting with a problem. I need to find 100 Rand elsewhere. Then I can use long-term or short-term finance to cover the shortfall. Okay, then they look at different ways of doing that. So now, how do I cover the shortfall? Right, so are you comfortable with having minus 100? Right? Let's say this was a monthly budget. Are you comfortable having minus 100 every month? Well, if you are, you need to find minus 100 somewhere. So you can either use cash or capital that you've taken out ahead of time. That's more conservative, right? Or you'd have to actively seek capital, right? And that's more aggressive. Okay, so those are things to consider when we look at managing the cash flow. All right, so accounting versus cash flow. There's an example on page 96. Okay, I'm just going to discuss the key important bits and pieces here. Okay, we looked at inflows and outflows. So if I'm looking at classification of cash flows, right, we just spoke about this, inflows and outflows. Right, so in the actual textbook, they give you like a table that talk about things like inventory, things like depreciation. Okay, it might be on a different page in the new textbook. I'm not too sure if I've referenced the new or old here. Let me just confirm for you. Okay, page 96. Let's have a look. No, not in textbook second edition. Yours is probably right. Yes, that is it. That's on page 96. So in the new second edition,
should be anywhere from page 107 on, from the
yeah,
first chapter, from 106 on.
Correct, yes. So that would be, yeah. It depends on which textbook you're using. Yeah, that's the one. All right, 107 is correct.
107.
Yeah, 107. So 96 is for first edition. 107 is for second edition. Just depending which textbook you guys have got. Okay. All right, but if you look at that diagram, have a look at how much movement we have there in terms of cash. Right. Cash is used everywhere. It's universal. Right. That's why accounting is always part of a BCom, because that's a language. Okay. So when people talk about assets, liabilities, income, expenses, you know what that has. You know what meaning that has in terms of bigger context. Okay. So do all transactions have a cash flow effect? No. All right. So if you look at this diagram, okay, is there anything here that you would identify as being a non-cash item? Okay, why is an accrual not cash? Correct. Okay, it's a provision for something that is going to happen, or it's a provision for something that has happened. Okay, so you get things like prepaid expenses. Is a prepaid expense a cash transaction? No. See, that's all your accounts, right? Is an income received in advance a cash transaction?
Income received in advance?
Yes, it would.
Yeah.
Okay, because that's cash you're receiving today for services you haven't completed. All right, so all of those have a cash flow effect. We either add or subtract from the actual working. Okay, so not all transactions have a cash flow. Some do, some don't. You need to think about, is it an accrual or is it cash? Okay, remember, we're looking at the decision making, so for us, cash is key. Okay, but you need to understand the counts, accrual versus cash, because if you don't know what accrual is versus cash, you wouldn't be able to identify if the transaction has a cash flow effect or not. Alright, so what calculation do we need to do for this particular consideration? Okay, we're looking at income and expenses. Alright, this is something that you would have covered in FAC 1601. Right, when you look at something like this, okay, you're starting here, which is the net profit after tax, which is right at the bottom of the statement. And if I go bottom up, that's the indirect method. Okay, so you had indirect and direct when looking at cash flow statements. Alright, so you don't need to know how to draw up that statement. It's not important. You just need to think about this logically. Where am I in terms of the information? Am I at the top or am I at the bottom? Net profit after tax is at the bottom. Right, so I'm starting at the base and I'm moving up. Okay, so if I'm moving up, what do I need to do? Well, let's quickly draw an example. Let's write down expenses. Okay, and I'm going to put expenses here of, let's say, 10. Right, and then part of the expenses, I'm going to put depreciation of, let's say, 2. Okay, and that's going to give me operating profit of 8. Alright, then we'll just say that's the EBIT. Okay, just to keep it simple, EBIT. Okay, let's do it this way, it's neater. Alright, so let's talk about expenses. We said 10, depreciation, we said was 2. Alright, that was part of the expenses. Okay, so I've obviously expanded on here. Let's move that aside then. Okay, and then other would have been the 8. Okay, just to show that. Right, then that gives you the EBIT. Right, the EBIT would have been a separate calc for all the income plus all the expenses, giving you a subtotal. Right, then I'll have interest and tax. I'm going to ignore interest. I'm just going to put tax. Alright, so tax, we'll say in this question, is 28% at 28%. Right, so 10, EBIT, I forgot to put income. Let's put income as 20. Alright, so that gives me EBIT of 10. 20 minus 10, 10. Tax would be 2.8. Right, so this would be your net profit after tax. So what is your net profit after tax? 10 minus 2.8.
What happened to depreciation?
We're not looking at depreciation yet. Okay, we're looking at normal accounts. So this would be your accounting. Right, so in your income statement, okay, in your income statement, your statement of comprehensive income, you would be showing what? 7.2 as a net profit after tax. Right, you as a business are going to have to consider, is this cash flow? That's what we're trying to determine here. We're determining the operating cash flow. We want to know how much cash is actually coming from your operations. Well, let's interpret this. Right, then obviously in accounts you would have used direct method and you would have used indirect method. Okay, I'm just recapping a little bit of your prior knowledge. Okay, so income is what? Inflow. Expenses, 10, is that inflow? No, part of it is, part of it isn't. This is the big non-cash. This is outflow. And that's how you would do it direct. So what would direct be saying? Direct would be saying, that's an inflow, that's an outflow. So what's 20 minus 8? Okay, 12. So OCF would be 12 here. Right, because we had 20, we forgot about the tax, minus the 2.8, which was the tax. So OCF would be 12 minus 2.8 gives me 9.2. Right, so operating cash flow here would have been 9.2. Right, that's the cash flow. Is that good or bad? That's good. Is that more or less than this? It's more. Right, so have a look at the working you have in your book. Right, what do they say you must do? EBIT times 1 minus the tax gives you the net operating profit, okay, which is what line item? This line item. So in this question, we've been given the bottom part of the statement. So am I using direct or indirect? I'm using indirect because I'm starting at the bottom and I'm adjusting for it. So you guys know that 9.2 is cash flow because the 20 is what you get, the 8 is what you pay, and 2.8 is what you pay. You pay, you pay. Okay, outflow, outflow, inflow, outflow, outflow. You know this is non-cash. Okay, so indirect method, how do you work it out? Well, indirect method says you start with the net profit after operating tax and you add back non-cash. Remember that from indirect method, yes, no, maybe, maybe not. Okay, but we've recapped it. Okay, so what is my net operating profit? 7.2. So OCF would be 7.2 plus what's non-cash? There's the non-cash. Okay, and that's how you did a cash flow when you did this, whenever you did it, okay? Last semester, your semester before, whenever, okay? Plus 2. So you still get same answer, right? Okay, so this module is using this, the indirect method. Okay, so when you see questions in past papers, assignments, and so on, right, they're always going to be using indirect. Because from a UNISA point of view, it's easier giving you one item on the income statement, either EBIT or NOPAT, okay, net profit after tax. Right, so from a UNISA point of view, they'll either give you that, EBIT or net profit. Okay, then you just adjust. So we need to remember the steps. If I've got earnings, I first take out the tax. Then I've got the net profit, which is what we have here. Okay, so to get net profit, how do I do it? That's step 1. Step 2 is then to add back the depreciation or any non-cash item. Right, is that okay, guys?
Yeah.
Okay, so now you guys have a working here. I want you to please calculate OCF, given that information. What's the operating cash flow? How are we doing? Do we get an answer?
85.
385. I think I've got the answer here. No, I don't. Let's put them up. Okay, so you would have typed in brackets 500,000, okay, times 0.72, close brackets, plus 25,000. Okay, if you type that into a calculator, you're going to get an answer. And you said we got 385. Okay, that's the working. Alright, so we would do the same thing for these as well. Alright, so see if you can work those two out as well, okay, in terms of tax, EBIT. Okay, this comes up a lot, EBIT. It's given as part of a bigger question, a longer question. It can be a short question. This exam is half written, half multiple choice. Okay, so it could come up either or. I'll put the workings up here, and then once you've done it individually, then just check with the workings that I've got here to see if you're happy with the calc. Alright, so those are workings in case you need. And then you should get a final answer eventually.
What did you get for the second one? You haven't done it yet.
I haven't worked them out in terms of arithmetically. 620.
Yeah, sorry.
Okay, second one. Final answer. 255. Do we agree?
Yes.
Great. Okay, so yeah, just type in that figure. There's the working to get the answer. Alright, so if you did follow that, you'd be okay. Right, just take off the tax first. I'm taking off tax by timesing it by 0.70. That's all I'm doing. Okay, just to save a step. Right, if you do it differently, that's fine. Work out the tax first, then minus it, then add it back to depreciation. It's not going to matter, okay? As long as you get in the final answer that's correct, no one's really going to mind, okay? Alright guys, and then last bit is this, which is the free cash flow. So now you guys have a good understanding of what cash flow is. Do you agree? 3 sections: operating, financing, investing. It's broken up to inflow and outflow. Right, but now from a decision-making point of view, okay, who owns the business? Well, that's one, okay, in terms of shareholders. Alright, so this you should know from other modules. Alright, and that's why you guys should find this module easier if you've completed all the others. So if you've done FIN3601 and you've done FIN3701, right, this one shouldn't be so bad. Okay, if you do it concurrently, it might be a bit more tricky because it does overlap. Okay, so now you guys have all completed the 3701, so we know shareholders can own part of the business, and we know debt, i.e. borrowers or lenders, okay, that's the borrowing. Okay, so lenders, right, they don't own the business, they finance the business. Alright, so that's how companies are financed. Okay, when I ask the question, the answer is there: debt and equity. Okay, what free cash flow is looking at is this: what's available to the investors. Okay, investors are who? Shareholders. Alright, i.e. people that have invested. Right, so owners, okay, obviously creditors would be part of the owners because they are entitled to pay out if a business is insolvent. Okay, so before the owners get paid out, the creditors get paid out. Okay, so after the company has met all operating expenditure and they've invested in fixed and non-current assets. Okay, have a look at that. Cash flow is what? Operating and investing. So what are you left with? The financing. Right, so remember, cash flow, the cash flow statement is broken up into O, I, and F. Okay, we know that there's only 3. Right, there's only 3 categories in terms of cash. Right, so if I'm looking at operating and I'm looking at investing, what must be left? The financing. And that's actually what the free cash flow is telling you. That's all it is. It's just the free cash flow in terms of what's available to debt and equity. That's basically what you're trying to work out. This is actually the free cash flow. Right, the accountants just didn't talk about it as being free cash flow. The accountants talked about it as being financing activities, cash flow attributable to financing. That's what they refer to it. Okay, but if you understand the accounts and how it fits in with the finance, it's pretty easy to do. Okay, is that alright, guys? Great. Okay, so there's the working. I've completed this example for you, so there's not too much that you have to fill in. A lot of it has been done. Okay, there's the formula. Right, formulas need to be learnt, okay, studied. So I do recommend you study that. Okay, for this module, there is no formula sheet, so you do need to know it. Okay, for Lee, in the investment module, you don't need to know all of it because you get a nice big formula sheet. Okay, so that's a nice module. Okay, you just need to know how to use everything. Okay, all right. So the free cash flow, there's the formula. Make sure you know it. I've put the acronyms there so you know what each of them mean. Okay, just remember it's what operating minus investing gives me the financing. Okay, simple. Okay, cash flow is broken up into 3 categories. Which one am I looking at? The last one, the financing. Alright, so there's a few examples in terms of last year and this year. Okay, I've just randomly created these figures. Okay, given the OCF of 450, you need to calculate the FCF. Right, so we know what this amount is. It's given in the question. 450 is already given. 450. Right, all you need to do is find out what are non-current assets and what are non-current assets and what are current assets. Okay, so do I need to look at the liabilities? Yes, because I'm looking at short term. Okay, do I need to look at the long term? Yes, but separate. Okay, so you're working here. Right, there's the first one. NCI. What is NCI? Non-current. Okay, so the non-current would have been, well, this is the non-current assets, okay, plus the 1 million. Have a look. Okay, there's the non-current assets plus the 100. Okay, that's depreciation. Okay, remember depreciation is non-cash. Okay, so what do? We need to add it back. Alright, so 1,200 minus 100, not minus 100, minus 1,000, okay, then plus the 100. Alright, so that's where those figures are coming from. Right, then we're looking at the current assets. So, if I go back to the example, okay, I'm going to highlight the current assets here. Right, so here's my current assets, here's my current liabilities. I'm looking at the difference, the net current asset investment. Okay, net means after. Net income, net profit, net means after. Okay, so I look at this and I look at that. Okay, I take the one and I subtract the other. Alright, so let's show that working. There's it. Okay, so this is my current assets. This is my current liabilities. Alright, the one minus the other gives me the net. Okay, so if I look at that, that business is in a pretty stable position because your current assets changed, so did your current liabilities. But the current assets and the current liabilities changed the same, so there's no need to raise additional capital. Okay, does that make sense, guys? Alright, OCF is given. We didn't need to do anything there. Okay, normally you don't. Alright, and then the last bit is the final working. So take your answer for each of them and just get the net. Okay, the 150. Right, and that's the free cash flow. Right, which is basically, if you had to do this the accounting way, you would have drawn up the statement of cash flows and you would eventually have gotten operating, financing, investing, and you would have seen 150 also sitting in the financing section of your statement, basically. That's what you're saying. Okay. Is that alright, guys? Good. If there are any questions, feel free to ask. Alright, this one is for you guys to calculate. I've done one with you, walked you through the process. Try it. See how it goes. Remember, each working is done separately. Okay, so maybe just to help with some guidance here. This is the first one, which is net, okay, non-current assets. So non-current would be that and that plus this. Okay, and then if I highlight the other bit, okay, this one over here, then that would be the short term, which would be the current assets and the current liabilities. Okay, so just keep it separate. Okay, maybe something that I should add to this, maybe just to consolidate everything, OCF. Okay, I'm going to add an extra working here for OCF. We saw on the previous slide, OCF is what? Net operating tax minus the tax. Okay, so EBIT minus the tax, obviously, plus the depreciation, yes. Okay. Okay, so they all build. The one builds on the other. Any final answers yet?
1-1 for that.
1-1.
Yeah.
Let's have a look. The answer is there on the next page. This would have been 400. No. Yeah, not quite. Okay, so the OCF was given. Alright, so this was the 2,000. Okay, this was the non-current assets, the change. So last year and this year. Okay, we add back the depreciation, it's a non-cash item. Okay, so are we all happy with the 700? Alright, great. Okay, so you guys all got that right. Okay, it might have been here where you got this wrong. Maybe the negative, remember a negative of a negative is a positive. Alright, so if you didn't put a bracket in your calculator, you might have gotten a wrong answer. Okay, not because you didn't know how to work it out, just because the calculator did the calculation incorrectly because of BODMAS, obviously. Okay, brackets first before addition, subtraction. Okay, and multiplication, all of that. Alright, so the final answer we should be getting is the 400. Okay. Is that right?
What happens
You got it?
if
Nice.
FCF was a negative?
If FCF
Was a negative.
was a negative, then there wouldn't be any free cash flow available to the firm, yeah. Okay, so it could be, right, free cash flow could be positive or negative. Right, you'd obviously want free cash flow to be positive because if positive, then in terms of financing, there's cash available to debt and equity in terms of investors, creditors and shareholders, basically.
That's
Yeah.
still available to get the income.
Attributable to both, yeah, financing. Because remember, financing activities cover both debt and equity.
So they are just for the equity sector.
Okay, you're thinking about the investment stuff where we had free cash flow to the firm in terms of FCFE. Then FCFE, we took out the debt,
So we don't
the
go that
borrowing.
far.
No, yeah. Okay. Right, and then the last bit is just a note about long-term and short-term. What are we going to be focusing on? It's this, short-term. Okay, why? FIN3701 covered the long-term. The FIN3702 covers all the short-term. Alright, so just keep it simple. You're looking at months, days, weeks, right? Maybe 2 years, but not more than that. Okay, even for budgeting, it'll generally be months. Alright, guys, and that's pretty much it for this week. As I said, it's a very short module. It's not as hectic as FIN3701.